Welcome to the Pro Ticker Deep Dive. So today we're asking something that probably seems simple, but it's got some really complex stuff behind it. Why does, that carton of milk cost so much more in one EU country compared to literally right next door? We're specifically going to dig into this Dutch supermarket showdown. Shoppers there are noticing prices, well, reportedly up to 15% higher than just across the border in Germany. And this isn't just grumbling, right? It's actually kicked off a proper regulatory investigation.
It really has. I mean, a 15% gap, that's a massive chunk out of the weekly shop, especially now. People are already feeling squeezed. And the fact that the Dutch Authority for Consumers and Markets, the ACM, is launching a formal probe, well, that tells you how serious it is. They're looking into, potential abuses of market power, are suppliers creating bottlenecks, or, and this is the big one, are the supermarkets just prioritizing profits over everything else?
Right. So for you listening, whether you're, say, managing a portfolio or just trying to get a handle on the economy, this matters. We could be looking at a real shift, maybe like a structural reset for food retail in Europe. This kind of regulatory heat means that whole idea of grocery stores being a safe, defensive bet, it's definitely being tested. Understanding how these companies react, their strategies, their finances, it's suddenly become much more critical.
Okay, so let's unpack that risk before we dive into the retailers themselves. What's the mood? How is the average European shopper feeling right now? Why is this price gap hitting such a nerve?
Oh, they're stressed. Exhausted, really. You hear about headline inflation cooling down from those crazy peaks in 2022, 2023. And yeah, overall CPI has come down. But food inflation, that's the sticky one. It's still running pretty high in a lot of places, and it's something people see every single day.
Yeah, you feel that directly. When groceries cost more, it eats into everything else. People cut back.
When you feel okay financially, maybe you buy some extras. When you feel squeezed, you notice every single price tag on the essentials. And there's data showing that disconnect, isn't there? Like overall, inflation is easing, but food is still outpacing it.
We see it very clearly in the UK, for example. General CPI, it's dropped below 4%. But food inflation, even though it's come down a bit, was still over, 5.4% recently?
Yeah.
That gap, that persistence, it just erodes confidence. We've actually seen consumer confidence fall for 4 months straight in the UK. People are just nervous, hesitant to spend, even if their wages have gone up a tiny bit.
And that nervousness, that feeling of being squeezed, it always turns political, doesn't it? Governments feel pressure. We saw it with energy caps, fuel subsidies. They need to show voters they're doing something about the cost of living.
Absolutely.
So this Dutch investigation, it's partly about economics, sure, but it's also about sending a political signal.
It's definitely powerful political messaging. We're watching out for you. And it forces the industry onto the back foot, having to justify every price increase. That kind of uncertainty is tough for retailers who rely on stability.
Yeah, stability is key. And sometimes things completely out of their control can mess that up. Like the weather. Our sources mentioned this weird thing in the UK, warm start to September, then bam, heavy rain and floods up north.
Yeah, that sort of thing has an immediate impact. Local disruption, straight to the bottom line. Heavy rain keeps people away from high streets, traditional shopping areas. Foot traffic just tanks. People might order online instead, or maybe head to those out-of-town retail parks. Interestingly, those retail parks did a bit better, apparently. Less reliant on just casual browsing. It just shows how crucial that steady flow of customers is. Anything that disrupts it forces retailers into maybe lower margin ways of selling.
Okay, so that brings us neatly from the kind of macro picture, the consumer stress, to the actual business itself. We tend to think of supermarkets as these giant cash machines, right? But what's the financial reality? What are the margins really like?
The reality is pretty tough, actually. Food retail is famous for razor-thin margins. We're talking net margins, so after all the costs, often down around 2 or 3%, maybe even less sometimes. Their whole model is built on huge volumes and just ruthless efficiency. A tiny shift, even 1 percentage point in margin, can have a massive impact on their overall profit. Double it or halve it, potentially.
Wow. So when the Dutch regulator asks why prices are 15% higher than Germany, they're basically asking if that tiny 2-3% margin is justified. Or has it been sort of artificially puffed up because there isn't enough competition or maybe some dodgy practices going on?
Precisely. That's the core question they're trying to answer. They're looking at 3 main possibilities. One, is it just that the Netherlands doesn't have those super aggressive deep discounters like Germany does, pushing prices down? 2, are Dutch retailers genuinely facing higher costs, wages, energy, or maybe suppliers charging them more? That's a big one. Or theory 3, are they just using their market power to charge more and boost profits deliberately?
Okay, and let's game that out. If the regulators land on theory 3, that consumers are being unfairly charged, What's the worst that could happen to these supermarkets?
Well, the nightmare scenario for them is regulators stepping in and forcing margins down. Policy-driven compression. That could mean anything from, say, price caps on specific essential items, milk, bread, that kind of thing, or maybe much stricter rules around the contracts between the supermarkets and their suppliers. For a company where the operating margin is already paper thin, imagine being told you have to cut prices on key stuff by even 0.5%. That hit goes almost straight to the bottom line, straight to earnings per share. It could be catastrophic. And that risk, well, it really undermines that whole safe defensive investment idea.
But pressure creates diamonds, as they say. Or at least it should spark innovation. If regulation is squeezing the old ways and costs are going up, retailers have to fight back somehow, right? What are they doing? How are they innovating?
They absolutely have to. Standing still is just not an option. So tactically, one big push is into different store formats, things that give better returns per square foot. We're seeing a really aggressive move into convenience stores. Smaller shops, high-traffic spots like airports, city centers, petrol stations, often linked up with click and collect too. The margins on those impulse buys, grabbing a sandwich and a drink, they're much better than on the big weekly shop.
And the whole delivery thing, that race seems to be getting faster and faster. It really took off during the pandemic, but now it feels like people just expect it instantly.
Oh, completely. Minimizing delivery time is huge now. You've got big UK drugstore chains, for instance, offering 30-minute delivery on thousands of items. That takes serious tech investment, slick logistics. And for investors, looking at that digital side, it's not just a nice extra anymore. It's becoming a key defensive strength. If you can sell online effectively, maybe it shields you a bit from local price regulations in physical stores, diversifies your income.
So all this pressure from regulators, from competitors, it's almost forcing them to get leaner internally, too.
Yeah, it's like the ultimate catalyst for efficiency. They have to pull that lever harder. We're talking more automation in warehouses, using AI to predict demand better, reducing waste, using data to get tougher in negotiations with the suppliers, too. The companies that really nail this internal efficiency drive, they're the ones who might be able to absorb cost shocks, whether from inflation or regulation, without totally destroying that crucial 2–3% margin.
Okay, let's bring it all back to investing. What does this grocery reset, as we called it, mean if you're looking at your portfolio? Is food retail still that safer defensive play compared to, say, general retail fashion and stuff, which can be so much more volatile?
Well, that contrast is really being put to the test right now. Traditionally, yeah, food retail trades on lower price to earnings multiples, maybe 12 to 15 times earnings, because it's seen as reliable, steady cash flow, defensive. General retail, fashion, homewares trades higher, maybe 18 to 25 times earnings, but it swings wildly with trends and consumer mood. Double-digit volatility isn't unusual, but now this threat of regulators squeezing margins, it chips away at that core defensive argument for food retail. So maybe that lower valuation isn't a bargain right now. Maybe it actually reflects this new ongoing risk.
We should probably spell out those specific risks because it's not just about the Netherlands, is it?
No, definitely not. First, there's that direct margin compression we talked about, negative spread. Second, currency and macro shocks. A lot of big European retailers aren't just in Europe. They have businesses in emerging markets, Brazil, Argentina, places like that.
Yeah.
And if the local currency tanks, like the Brazilian real weakening, well, when they convert those earnings back to euros, they just evaporate. It slashes the profits reported back home.
And the third risk, looping back to the start, is just that fragile consumer confidence.
Exactly. Because when confidence is weak, what do people cut back on first? The high-margin stuff. They trade down from the fancy own brands, the ready meals, the non-food items like flowers or seasonal decorations. They go for the absolute basics.
Yeah.
And that switch in what people are buying really hurts the supermarket's overall profit mix.
But okay, risk means volatility, and volatility can mean opportunity for careful investors. Where might you look for value in this messy picture?
I'd say focus on two main areas. First, companies that are genuinely showing they've mastered that digital expansion and the operational automation side, the ones proving they can handle rising costs internally. Second, look for what you might call selective value.
Okay, let's clarify that selective value. What does that mean here?
Right. So selective value in this situation means looking for fundamentally decent companies whose shares are trading well below their usual historical valuation levels. Why? Because the market is maybe overreacting to this short-term regulatory fear. If it turns out the regulation isn't as harsh as feared, or if the company manages to innovate its way through, there could be significant upside as the valuation recovers. It's about finding where the market might have priced in too much bad news.
And if we glance at a specific stock chart, say for one major European food retailer, the picture really tells a story, especially for technical traders. It's slid quite dramatically, hasn't it? From near €18 in early 2023, now kind of bouncing around the 12 mark.
Yeah, that 12 level looks absolutely critical on the charts. It's been tested quite a few times over the past year or so. It's acting as support. Now, if that support level holds, technically you might see a bounce back towards resistance around 15-year.
But if the bad news, the fundamental regulatory risk, actually breaks that 12 floor,
Then the downside could be pretty significant, yeah. Breaking that 12 support would suggest the market's really losing faith in the company's ability to navigate this whole grocery reset. It is interesting, though, that some of the UK players look maybe a bit more stable on their charts. Perhaps they have stronger sales volumes, or maybe they're seen as slightly more insulated from what's happening on the continent. But, they're certainly not immune if this intense focus on pricing becomes a wider European trend.
so it really comes back to this central idea, doesn't it? This Dutch investigation, it's like a warning shot. Food retail is moving into a different era. Governments are watching profits closely now. The idea that food margins are somehow sacred territory, that seems to be over.
Adaptability. That's the absolute key going forward. Companies that just rely on putting prices up what they might have done in the past, they're going to get squeezed badly. The winners will be the ones who've already put the hard yards into becoming super efficient, automating their supply chains, and building strong, profitable digital channels.
Yeah, so the really crucial question in this great grocery reset isn't just what things cost anymore. It's about how fast and how well a retailer can completely reshape its operations, logistics, digital, sourcing to swallow rising costs, while also keeping regulators and ultimately politicians happy about prices. That ability to pivot, to adapt under pressure, that's where shareholder value is going to be made or lost in the next few years. See you all in the next Pro Ticker Deep Dive.